What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. Preparing for today's highly anticipated FOMC meeting with the Horse, Markets and Mayhem, and Ayesha Tariq. Today's podcast is sponsored by TradeStation and FTSE Russell. Currently, TradeStation is running a promo just for our audience. New users get 50% off brokerage fees for the lifetime of their account using the promo code FUTRAFZT. Go to tradestation.com/Anthony to learn more. Did you know that with an 81% share and 1.6 trillion in institutional assets benchmarked, the Russell 2000 is the top choice by far among institutional investors? CME Group has selected the Russell 2000 index for new event-based contracts launched on September 19th. The daily options on futures contracts will offer short-term trading opportunities for investors seeking to take a position on the Russell 2000 futures daily price moves. For more information on the Russell 2000, go to FTSERussell.com. All right, let me bring in the crew. Let's bring in the Horse, Mayhem, and last but not least, Ayesha. How are you guys? What's going on?
Hey.
Happy Fed Day.
Yeah, happy Fed Day, right? You know, Horse, you and I we're the knuckleheads in this group. Kind of goes without saying. It's nice to have the brain power of Ayesha and Mayhem in here.
That's right.
To help us kind of navigate through what's going to happen today. And, you know, maybe we'll start with you, Mayhem. I think you put a tweet out saying that you don't think the Fed could go 100 points, but I see a lot of people saying that it could happen. I mean, I looked at CME's Fed tool. It said 82% would be 75 basis points. So obviously there's a chance it could be more, but obviously most people are expecting that. I mean, what do you expect today?
Yeah, I mean, they could do kind of whatever they feel like doing, right? But I have the inclination that they're not going to try to shock the system with 100 bips. I think they're going to do another 75 bips. This is already one of the most rapid tightening cycles in terms of just the velocity of rate increases that we've seen in a very, very, very long time. And it's caused, already a fair amount of tightening of financial conditions globally, not just the Fed, but other central banks acting in concert. So obviously they could do whatever they want. They could even do 50, but I think the most likely scenario and the one that I would anticipate happening today is they raise by 75 bips.
Ayesha, how are you feeling about this?
No, I think the same. I mean, I like to read a lot. So every time Powell gives a speech, I go back and read the transcript again just to punish myself a second time. So last time around, I think in the last meeting, what he said was an unusually large increase would be appropriate. Another unusually large increase. And you have to remember, when they speak, everything is very measured, right? So their words are very carefully chosen. They don't say anything out of turn, or they try not to at least. And even at Jackson Hole, he said the same thing. I mean, he reiterated what he said in the July meeting. So I don't think that they would do 100 basis point increase. And if they were thinking about it, I think we would have some inclination, because just as Mayhem said, I don't think that they would want to shock the system. It's not something that they're likely to do. So in the past, whenever they've cut rates drastically, or without warning, let's say. But when they're raising rates, they try to have like the market informed. So if you remember when they did the rate increase in June, like the sudden 75 basis point, there was a bit of a leak beforehand through the Wall Street Journal that we might be getting an upsized move. So I don't know if the Fed really leaked it or what happened, but I don't think that they would shock the market, just as Mayhem said.
So, Horse, like I said, you and I, we're not the macro people, and we don't claim to be, right? That's why we surround ourselves with good people like Ayesha and Mayhem. What is your thought process when you come into a Fed day like today, and you get all that information from Ayesha and Mayhem? How does it actually help you with your execution?
Well, I'm usually thinking about what time I want to tee off or where do I want to go for lunch, because the best thing you can possibly do as a trader on days like today is to stay away. If we're being completely honest, these are very outsized moves. And I think, It is, in a sense, as a trader, there's an aspect of gambling involved, right? Because we don't know what's going to happen. So for me, it's really trying to understand the extremes where I would want to join in the party as a trader on the back of momentum. Honestly, we're in a bit of a precarious situation holding right here in this area in the 3,800s. For me, the cutoff, the line in the sand is 3,850. So my messaging on that hasn't changed for quite some time. I think below that, you have a chance for new lows to come in. So that's really all I'm watching is if we happen to get a shock and price goes below that level, that's a place where I would be interested in shorting. In the meantime, I just don't think there's a whole lot here from a risk perspective as a trader that I'd be interested in. However, I think the path of least resistance is up. And I know that probably not everyone agrees with that. Even my cohorts might not agree with that. But just going off how we've seen these play out in the past, there is obviously natural hedging coming into events like this. And no matter what the news is, the effect of those coming off can be very powerful, as we've seen in the past. What has my attention today is above 39.05 on ES for bullish trades and below 38.50 for bearish. In the middle, we're just kind of in the chop zone. I have no interest in engaging. The market's sort of consolidating, waiting for the news. But truth be told, I'm a little more risk adverse probably than most. So the best thing you can do on days like today is watch the fireworks, and there'll be plenty of good trading opportunities afterwards.
Yeah, it's amazing how productive doing nothing can be.
It really is. I think a lot of what we talk about at Trader Aid is trading for the long term, trying to help people navigate the markets for longer than one day and one event or one call. And these are the kind of situations where people can get really hurt if you're on the wrong side of something. So the smartest thing you can do in terms of capital preservation as a day trader is just to not be in a position prior to this. But I know people get FOMO pretty intensely, and I'm sure there'll be some that make out great and some that get hurt. But truthfully, if you're just looking at where we're at, even on the chart you have up there, I do think there's room to the upside. If you see some of those hedges coming off, you have those key moving averages lurking just above 4,000, the 100-day, 20-day, 50-day, everything is overhead. And from a technical perspective, you go back and look, say, from like September of 2021, there is a downward sloping trend line that the market has just been flirting with nonstop for very, very long time if you were to draw that. And we're currently sitting right on it. So it's really a coin toss as to which way this thing breaks. But for me, those are the key levels I'm looking at, 39.05 and above for long trades on the news and below 38.50 for shorts.
Yeah, well, let's bring in Mayhem, who, listen, hat tip to you, man. I got to tell you, you were pounding the pavement on that rally with your tweets. I mean, you were like, you know what? Another bounce in a bear market. I'm still bearish. And let's face it, that takes some guts to do that, because I think a lot of people were thinking, we haven't taken out the low yet, right? If we do, who knows? But we came off that pretty hard, and you were somebody who's been really vocal about this really the whole year. I mean, I would say that you've been really vocal about it, and you're somebody who puts your money where your mouth is. Not only you good at your macro stuff, but you're trading it as well. I mean, where do you sit right now where we are here?
Yeah. So I would say coming into today, this is really not a well-hedged market. If you look at put skew, it's very low. So there's a lot of FOMO. Institutions are actually participating much more aggressively on the call side than we typically see going into a day like today. Then if you look at the delta between realized and implied volatility, you see the same thing. There's not really a big premium in implied volatility here. So what I'm seeing is that, yeah, we could get a pop, especially if you got a 50 bip hike. I think that would unleash a lot of positive momentum.
Oh, yeah.
75, I think we get a fadeable pop. 100, I think the market drops significantly and makes new lows, because that would be a pretty big shock to the system that's not well priced in. And I appreciate the kudos. I mean, Ayesha and I have both been on the same page on that in the sense that, structurally speaking, this is a longer term bear market, and Horse has too, but he's more focused on the day-to-day stuff. But, we're all kind of in agreement that longer term, we're in this structural bear market with more room to the downside and quite possibly new lows to come. And the reason that I'm kind of aggressive out there when we reach these, what I tend to see as kind of irrational highs, the last time was a situation where risk premium was not being properly expressed in stocks. Bonds did not believe the rally at all. And the leadership was a lot of low quality junk, a lot of, unprofitable growth and meme stocks really leading the market in terms of their gains versus other sectors. And that's not what you want to see. That's something that really tells me there's more short covering and passive flows and momentum chasing than actual conviction being expressed. So that was the other reason I kind of raised the red flag, is it's like, look, the smarter market, the bond market, is telling us this isn't real. And then what's actually running isn't the sort of stuff you really want to be long or see running the way it is. And yesterday we had a pretty interesting day, and we've seen this a couple times here, where ETFs like ARKK run out of units to short. So you see this high beta, long duration risk getting a bid when the rest of the market's kind of getting sold down. And the reason for it, I would imagine, is you've got these long short books running leverage. On the long side, all their safe haven stuff is getting trounced. Yesterday, utilities, healthcare, and staples were getting sold down. And meanwhile, you saw a lot of this high beta, long duration risk getting bid up. And I feel like they're getting hit so hard on their long side, they have to start covering their short side as they deleverage. And that was another thing that tells me it's a little precarious.
Ayesha, I want to go to you, and I want to talk about scenarios. And Mayhem touched on it a little bit. 50 basis points, he thinks would unleash a rally. 75 basis points is probably a rally to fade. 100 basis points would probably melt down. And I think I would agree with that. I think pretty much that's probably consensus with everybody, even Horse and I, who don't know this stuff very well. Sorry, Horse, I keep throwing you under the bus with me, buddy. But
Hey, it's fair. It's fair, right? I'm a macro moron.
Exactly. The macro moron show. We'd be great at that. I'm looking more because I know how much you love to read, because it comes out in everything that you write, and that's why I read it. And it's because it's you really get in there and dig deep into the stuff. The statement, right? This is where obviously the 75 basis points, most likely that's what they're going to do, right? That's very low probability outside of that. You get to 75, all of a sudden everyone's the statement. What comes next? What are the key things we need to be listening for?
Consumer spending, unemployment, and the state of the economy, more or less like the GDP growth. So I think these are the three things that the Fed will probably, or they always do, focus on. So unemployment has been unusually strong. We know that. In fact, last month, unemployment rate went down. And over the last 4 weeks, I think what we've been seeing is jobless claims as well coming down. So this gives the Fed a scenario to tighten much more aggressively, or rather as aggressively as they have been doing. So that's one factor. I think the other factor that they would definitely be talking about is consumer demand, because that is exactly what they're trying to do: destroy consumer demand, consumer spending. Now, what we saw in the last retail report was a bit of a surprise, because it did go up a little bit. Even though your core retail sales were like flat, we did see a little uptick in overall retail sales. And a large portion of this is probably because of gasoline prices coming down. So now people have more to spend on other goods and services versus, having to spend it all on gasoline and food. So I think it does give us a little bit of a skewed picture over here, and even the unemployment report, because in the last statement, or rather during Jackson Hole, he did say that the labor force participation rate is not strong, which means your supply side is still weak and the demand side is still strong. So again, destroying demand for unemployment is yet another thing. Now, the most surprising thing that he did say last time around was that he sort of alluded to the fact that he knows that growth will slow down. So if you remember the last time we did this show before the meeting, I was telling you that I'd like to hear him say that the consumer is no longer strong and that we will enter a recession, or at least say something to that effect. I feel that they've now started speaking about it. I feel that they've started speaking about the growth slowing in the economy, and that is exactly what they need to see to sort of, achieve their goals. And if you look at what Powell is saying all through his speeches, he's actually mimicking Volcker a lot. And he even quoted him a little bit. I know that he reveres him. And that's why this morning I put a tweet out saying Happy Fed Day. And I put a picture of Volcker because I know we're going to hear more about Volcker today as well. And I think one of the things Volcker did say is that, they shouldn't shy away from recession. They shouldn't they shouldn't shy away from making the difficult decisions just because it induces a recession. And I think Powell is going down that route because he knows that all of this tightening will induce a recession. So that's how I see, or that's the three things that I'd probably look for.
Horst, before I get back to you with a trading question, I want to go to Mayhem just because I want to see what he thinks about what Ayesha said and ask you really the same question. What are we looking for in this statement? What are the things we have to be hearing for, reading, however we're getting this information that we think are going to have an immediate impact on the market?
Well, I 100% agree with everything Ayesha said, and we collaborate on a lot of our research, so we have a very similar viewpoint. So I'll just echo everything that she said. The other thing that I would add in is just the Fed has been pretty honest in the fact that they cannot do much on the supply side, right? We have inelasticity of supply as expressed by exploration, production, and transportation. And so what you have to think about in this situation is how does that resolve itself? The Fed can lean very hard on demand destruction. They can effectuate that by removing liquidity from the global financial system. So perhaps we'll hear a little bit more about quantitative tightening. Perhaps we'll hear a little bit more about what their ultimate terminal rate is going to be. Right now, when we look at Fed funds futures, they're pricing in a terminal rate to be achieved in the first half of next year of about 4.5 to 4.75%, which is a little higher than what I think the market, especially the stock market, but even the bond market with the 2-year at 4% is really realistically pricing in. So I think the statement is going to be really important. The dot plot, I know, Horst, you muted those keywords on Twitter, so you don't want to hear it too much, but I think the dot plot's going to be pretty important too. And ultimately, I think that it would be really interesting to see whether the Fed really gets a little bit more transparent that, look, all we can do with our very limited set of tools is destroy demand and effectuate a recession. Like Ayesha's saying, I'm 100% in agreement on that because that's really the best tool they have to subdue inflationary pressure. And another point that Ayesha made recently about the Jackson Hole speech was, the Fed might be a little critical of the legislature here. They're kind of fighting a battle. The legislature is doing all this demand-driven spending, right? The Inflation Reduction Act, whether it's ironically named or not, the CHIPS bill, some of these other things, they're going to be on the other side of the ledger. They're increasing demand at a time when the Fed is saying, hey, wait a minute, you guys blamed us for all this inflation. Now you're not really letting us fight it. Powell seemed a little irked about that. And I think that he's justifiably irked because if you really do want to subdue inflation, you have to have the government playing ball. So I'd be interested to see if they talk at all. I mean, they wouldn't be direct about it. They're not going to be overtly critical, but maybe they talk about some of the challenges they're facing with the limited set of tools they have and with the supply constraints and demand not necessarily being subdued to the levels they'd want. The Fed constantly talks about their goal of reaching 2% inflation as measured by core PCE. We're over 5%. So that's another issue that we have to contend with. We're nowhere near. And Mester has recently said that, look, we're going to keep hiking, even if it is into a recession, until inflation meets policy goals. And she went on to say she doesn't see that happening until 2024. So my gut take would be, I don't think the Fed pivots until they either get to that goal, as unlikely as it may seem, or more likely, they break something big.
Yeah, a couple guys I follow have been really on top of that as well. It was Macro Elf and Darius Dale, two guys I like a lot. They've been on the show. They said the same thing. I mean, Darius always talks about that. He's like, they're saying it's 2%. They're telling you what it is. I want to go back to you, Horst. I actually just want to pull up the charts again because this is kind of where you and I, we lean more, right? And on a day like today, I think, kind of piggybacking off of what Mayhem had talked about, with the rates and just, first of all, this 2-year, I was looking at this. This is the 2YY. You guys could pull this up. This is actually a really great tool. Even if you don't want to trade rates, I would recommend pulling this up because you hear a lot of us talk about, what are the rates? This is the futures on the rates. It's the 2YY. It's the micro 2-year yield. You can trade it or it just shows you the rate, which is nice. 4%, this is something I'm going to keep an eye on. Is this, what does this thing do? Because obviously as this thing continues to push highs, also I think I'll be looking at like the dollar, dollar's making new highs today. I'm actually long some nose in the yes or no contracts, the event contracts. Obviously, Horse and I are doing some stuff with place your trades because I think the euro is going to keep going lower because this dollar is just breaking out. So what in a roundabout way, what I'm saying is I'm just looking at other things besides S&P. What are some things that you're looking at, Horse, that you think are going to be important for traders to watch today?
Well, I mean, I'll be honest with you, Deli. On a day like today, I focus my energy. So I truthfully for trades would not be looking at anything other than my bread and butter with the S&P. But I think gold is always an interesting setup on FOMC days, typically to the downside. No offense to the metal bulls, but that correlation with the dollar is always something I keep my eye on. It is interesting that they are both green today. So I don't know what to make of that yet, because like I said, I try to focus and stick to what I'm good at on these high volatility days. But gold is typically a good one to watch on FOMC. Oil, I think there's too many factors right now. That's the other market I would typically be watching on days like this. But I think there's too much with the geopolitical tensions and situations for me to be able to read into what's noise and what's a tradable signal. So I truthfully, I can't really say anything else because I think what matters most is the S&P to me on days like today, because this is where you're going to see some of the largest bets expressed in the SPX and ES futures. That's where you're going to see the largest players making their bets. And that's where I think I would glean the most information, is watching that market extra carefully versus some of these other ones that I speculate in, but wouldn't call my strong suits.
Yeah, no, I'm with you too. I mean, S&P on days like today are the market I'd be trading, or I would trade like 10-year ultras is something I would trade as well. But I like to look at these other ones that you even mentioned just to kind of give me a feel of how the overall reaction is. I like to sit back initially and see what is the overall reaction, because most of us know that have traded these Fed days. There's always like three moves, right? There's the initial move, and then a lot of times there's that move that comes back, and then there's a move that either shimmy shakes back up or one direction and then eventually goes. It's usually like that kind of 3-part move.
Well, and truthfully, Deli, to build on that, there's actually a fourth one lately that should be noted, is the day after. The last few FOMC meetings have had very dramatic day after reactions. So I think that's another one to keep an eye on. No matter what happens today, you would obviously be very cautious of a fade of that, whatever the move ends up being tomorrow, because we've seen that play out the last couple times.
Oh yeah, no doubt. I mean, and that's why sometimes what I'll look for is just clues as to what's happening in other places that maybe spill over into like the S&P. And that's kind of where I go back to, if these rates, I mean, we'll go back to you, Mayhem and Ayesha. I mean, look at where we're at now. I mean, 2 years, 4%, so the 210, 4%, 3.575 pinned on the highs, 30s pinned on the highs, 5s pinned on the highs. I mean, how high are these things going?
Well, I mean, I think we have to kind of also just zoom out and look at supply and demand in the U.S. sovereign debt market, because we have some changes that are happening that are pretty important. One of which in the first half of this year was two of our largest buyers of our debt issuance have stepped back and actually started to distribute rather than accumulate, and that's China and Japan. So that creates an issue. The other is that during the third quarter in August, the Treasury upsized their issuance by 2.5-fold to $444 billion. And likely we're going to see a similar size of issuance in the fourth quarter because of increased spending, but also because of increased interest rate costs. And then we have the Fed doing QT up to $95 billion a month and up to $60 billion of treasuries in that started in September. So we have more supply, we have less demand, and we have a Fed that's saying, hey, there's more pain to come, and potentially rates going as high as 4.75%, maybe higher than that. Some have said that rates have to go higher than core PCE to really battle inflation efficaciously. But I would say that the path of least resistance from here, is going to be significantly higher rates. And the 2-year is starting to price that in. It's really been pricing this in all year long. If we look at the bond market, not only was it one of the worst starts to a year historically in like 40, 50 years, but now when we look at global bonds, it's one of the worst years so far since the 1940s. So there's a lot of distribution The 60-40 portfolio model is kind of dead this year. But to answer your core question, I think the path of least resistance for rates is quite a bit higher. And, you also look at the yield curve inversion. The inversion between 10s and 2s right now is 44 bips. That's the deepest inversion since like 2001. And it's lasting quite a long time, which just continues to increase the probabilities of a recession. So we're already kind of technically in a soft recession, but the way that the inversion's happening, I think between 12 and 18 months from now, it increases the probability that we'll see some kind of recessive economic environment as well. The bond market's kind of expressing a vote of no confidence right now in what's happening moving forward.
Yeah, I would love some historical information about how long you've had an inverted curve like this and like what happens from that. Right, like you said, I mean, the duration of it matters, I think, because what's happening, and maybe I should talk to us a little bit about when you have an inverted curve, what damage is that doing?
So obviously, and funny you should ask. I was just looking at the curve right now, and Mayhem's right. We're at about 44 basis points. So we all know what it signifies. It signifies a recession, right? Because you have like the short end of the curve going up and the long end coming down. But what's interesting is as you enter a recession, or you're well entrenched into a recession, the curve usually reverts, let's say, and the long end of the curve starts to go up again. And I think this is going to be, it gets worse when the long end of the curve goes up, simply because a lot of debt is actually keyed off the longer term rates, and not just sovereign debt, but as well as various sovereign debt around the world, because a lot of sovereign debt around the world is priced in dollars. You have corporate debt priced in dollars. So, for example, bank debt, the debt that I used to deal in, all of that is priced in dollars. So you have billions and billions of dollars of debt now getting, super expensive. And all of this pulls down companies even further. It pulls down asset valuations, and it basically inverts everything and puts you more into a recession. I'm sorry to be the bearer of bad news, but that's exactly how it works. And not until the Fed actually stops tightening will this change. Now, in terms of where the rates might go, obviously it's anyone's guess, but if the Fed is thinking that the terminal rate is good, or if the markets are pricing the terminal rate as 4.5, 4.75, as Mayhem is saying, then we still have a lot further to go in terms of bond yields. So I think we're in for a pretty rough ride. I don't think that this recession is going to be as easy and as shallow as people are making it out to be.
Mayhem, I'm going to go back to you just for a couple of things. From a macro side of things, why is gold just awful? Right. Why is it just awful? Explain to me. I'm not somebody. I've actually been somebody who's always fought against this idea that gold is a hedge against inflation. I remember in 2008, I was a very active trader. I had a bunch of stocks. I was doing great in the market. And everyone's like, "Hey, man, buy some gold, hedge against all this." And I just got whacked even more. Just go back and look at what happened. I mean, eventually it bounced when equities bounced. So I just wanted to know overall your thoughts on gold, because so many macro guys out there are just like, you just want to own it. And look at it. I mean, who wants to own that?
Yeah, it's really interesting what we're seeing this year. And I'll start with this, that we're sort of seeing this harmonized deleveraging across multiple asset classes. The sort of cross-asset correlation that we're seeing, particularly to the downside, is unlike anything I've ever seen. So, gold goes down, bonds go down, stocks go down, real estate goes down, crypto goes down, almost in the same pattern too. The sort of peaks and troughs. For gold in particular, I think one of the big things to think about here isn't just dollar strength and rising rates. Those are two big dampers on demand for gold, especially as rates, get deeper and deeper into positive real rates as the Treasury measures them. The other issue that I have is that the majority of physical demand for gold is from jewelry purchases. Jewelry purchases are inherently discretionary. What are people going to do in a high inflation environment? Are they going to buy more jewelry with money they don't have, or less? Probably less. So I think that's another concern for that market. And quite frankly, it hasn't worked as an inflation hedge as you said, going all the way back to 2008, there was this time where, there was this great idea that from, I guess it was 600 something dollars an ounce all the way up to the highs that it made up to 1900 or so, that it was going to be this great hedge, and the Fed was unleashing this enormous amount of quantitative easing, and it was going to cause hyperinflation and we're all going to die. And then what really happened was a lot of that quantitative easing went directly into financial assets because, of course, the transmission mechanism for monetary policy is directly into financial markets. And a lot of it didn't go into real world assets outside of things like real estate. So that idea that gold was going to be this hedge back then, it kind of got, I would say, undermined by that. And then also, in addition to that, crypto being kind of a relief valve for excess speculative liquidity. So maybe the younger generation embraced this idea that Bitcoin was going to be digital gold. And for a while, maybe you could argue that idea worked. I don't think you could argue it now that it's down 70% during a high inflation environment, but we are where we are. But I think that what's going on with gold is there's a lack of physical demand, particularly from individuals and from investors. Investors haven't had this low of an allocation to gold and gold mining in a very long time. And this is something that spanned over a decade. So maybe at some point there will be demand for it as a safe haven. What I've seen, particularly this year, is that it's more of a geopolitical attraction. When there's more, like when the Ukraine war started, we set another like all-time high in gold, right? We got very close to that level we were in August of 2020. So when there's some kind of event catalyst, that seems to be doing it. But in terms of inflation itself, as counterintuitive as it may seem, if people don't have a discretionary budget, if they don't have that elasticity to buy more jewelry or coins or bars, they're just not going to do it. And that demand starts to slip away.
Yeah, no doubt.
Just a couple notes to add on to that too. You can't ignore the pretty strong inverse correlation to the dollar as well, the DXY, and that broke a little bit in the summer of 2021 between gold and DXY, but definitely see evidence that correlation is back in full swing, and that just puts extra pressure on gold, which is, in fact, Deli, I don't know if you knew, gold is the new Bitcoin, and I think it also suffers. It suffers from really sketchy influencers trying to pump it online, like Peter Schiff, and I think it gives it a bad reputation when you get so many people trying to pump a product.
Oh God, that guy! I mean, and what's unbelievable about it is that he actually
I'm gonna get in trouble for saying that, aren't I?
When he actually gets questioned about it, he actually doesn't own a ton of it in his portfolios. He actually owns a bunch of stocks, so he actually owns a very small percentage. I've watched him when he's actually revealed that. So obviously, I'm not judging him, but I mean, when you push things for like that, or the Bitcoin people, and it's funny, even some of these popular Bitcoin people are taking Bitcoin out of their Twitter names. I've noticed that quite a bit too, and look, that's what it is. That's why we as traders, as individual investors, you can't be following anybody blind. You got to do your diligence. And anytime anyone says that anything is the place to be, that is the place to be. If there's anything I've learned in my life, that there is no one answer to anything. Do your own work. But it's a good point though, Horse. I want to get to oil real quick, just because I want to go to questions next. And I just want to know, maybe we'll go to you, Ayesha. What do you think about oil? Because with all this talk, with everything, whoa, look at that. That was a little spike that day. What do you guys, I mean, look at oil. I go back and I could think of so many top people that I follow that probably in this time frame, I would say right here, we're saying that, move this over a little bit, but you know what I'm saying, right in there, that oil is still going to go back up and make highs. And then here we are, and we're just getting, the chart looks very bearish to me. I mean, what's going on there?
So look, I think for the short term, oil does seem bearish. We do still have supply constraints, and I do think the OPEC Plus will keep the price of oil elevated, at least above $80 a barrel. 75 to 80 is where they're budgeted. So they would do anything that they can to keep the price above that. And I think that's sort of balanced out by the Strategic Petroleum Reserve releases over the last couple of months. So apparently the SPR has now fallen to the lowest since October 1984. So that's not very good, which means that the oil has actually flooded the market and brought the price of oil down. But at the same time, they have to replenish this as well. So there will be a time when buying will start and oil prices will start to rise again. Plus, we also have a lot of lockdowns in China, which means demand has come down. And if you look at the world demand forecast as well, they have tempered it down somewhat. Now, structurally, if you look at it on a longer time horizon, oil is definitely doesn't have enough supply. I mean, the world doesn't have enough supply of oil. So it will be going higher, or it will stay elevated, maybe at 90, 95. This is WTI, of course, maybe even 100. But for the time being, there are these factors obviously flooding the market, which is, bringing the price of WTI down. Brent is still trading quite nicely. And I think the divergence has increased a little bit, if I'm not mistaken.
Yeah, I don't watch the Brent too much. I mean, real quickly from you, Mayhem, then we're going to go to questions because I know we're a little short on time today. We're going to be ending here in just about 5-10 minutes. So, what are your thoughts on oil?
Sure. I echo everything Ayesha said. I agree 100% with what she said about oil. The other thing that I would add to it is it's just another component of what I was elucidating earlier, where there's just not enough supply, and demand has not even come back to levels we saw pre-COVID in this country. So if oil can rise this much with subdued demand, just imagine what happens if we actually have a reasonably strong amount of demand come on back online. And we have just, over a decade of malinvestment. There's not enough production, and it takes a long time to bring that production back online. So I think this is a longer term problem. I think we're going into a situation where, eventually when the Fed does pivot, when they break something or when they bring down inflation, the next credit cycle is probably going to be one where inflation comes back earlier, and oil is going to be a big driver of that because of that inelasticity.
Got it. It just comes down to is that right now, it's just not something that the traders and the people putting money into oil are really looking at, right? It's one of those things where it matters. It just doesn't matter now.
Right.
And at some point when it starts to happen, you have to be aware of that because this is a market where this chart could look as bearish as you've ever seen it. And all of a sudden the news changes and the people that have to buy oil are buying it. And you kind of throw technicals out the window there, right? Because now you're at the point where you've really got to follow that macro side of things to know that your line up there to be short doesn't mean jack,
Right.
because you're now all of a sudden in a situation where the narrative change, right? And everyone, I've always learned is that nothing matters in something until it does. And traders understand that. And when you try to fade something like believing that oil should be going up and it's not working, which is why I stopped trading it, after a few losers, you start to realize it's just not working. And when it starts to work, you'll see it and then you embrace that. Everybody, we're going to take your questions, put them in chat, quick 15-second break, and we're going to quick questions.
Get more choices in your futures trading. Explore TradeStation's advanced trading platform, equipped with customizable tools, charting features, hundreds of futures products, and more. Plus, get 50% off brokerage fees when you open a new account. TradeStation.
All right, we're back. Like I said, from that quick break, let's go to the questions. So the first question is from Robert, and what we're going to do is we've only got about 5 minutes left, but I'm going to try and go through them pretty quickly with all these because we got a good amount of them. Robert's asking is, how long is the dollar going to keep going? I think I kind of already asked you guys that throughout the day. Maybe we'll go to you first, Mayhem, with this one. What do you think?
I think it's going to keep going as long as the United States has more aggressive monetary policy and the rate differential between the US and the euro is favoring higher rates in the US. And I don't think the ECB has much choice but to pivot before the Fed. So I think the euro could weaken further, and it's the largest weighting in the US dollar index, which means the dollar can strengthen further as well.
Yeah. I would think without question, that's really, that's what you got to just be watching for. Level 2 trading is asking, can you guys share your opinion on political risk until January of 2023? We have a war in Ukraine and elections in November. I'll go over this a little bit myself. I mean, right now, everybody's looking at the Fed, inflation. It goes back to what matters. Yes, the political side of things matter. Right now, the market's not looking at it. Today's Fed day, market's looking at what's the Fed going to do, inflation, all these other things. I think for me as a trader, I always look at it as this is what I just said. Doesn't matter until it does. We'll see. I think when we get towards that time, it starts to matter. I don't know if any of you guys want to touch in on this. I just don't think markets are looking at it right now. What do you guys think?
Well, there's a lot of folks. I've seen a lot of dissenting opinions on especially the Ukraine situation being priced in, and I would strongly disagree with that. I think there's still a big potential shock there. Again, macro is not my forte, so I'm not going to pretend to be an expert. But I'm just addressing the specific comments that a lot of the Russia-Ukraine conflict has been priced in. I highly doubt that. I still think it's a very big risk. And I think the China-Taiwan situation is a huge risk that I don't believe that this concept that it's all been priced in, I think is way out of whack personally. Just my take. I think there's still pretty big risk in the markets.
Yeah.
Go ahead.
Yeah. Oh, yeah. Thanks, Anthony. And I agree with what Horse is saying. And I just wanted to echo that and also say, if you look at past conflicts throughout history, the market seems to sort of get micro-focused on them for the first week or month and then starts to ignore them more and more as time goes on if nothing truly unexpected happens. But, this morning we had Putin come out and basically say, look, I'm not taking nukes off the table. We're going to mobilize another 300,000 troops, however well-equipped or unwell-equipped and trained they are. They're apparently going to be pushing them into Ukraine over the next year or two. And I don't think the risk is priced in either. I think there's a lot of geopolitical risk, China, Taiwan being others, but we're kind of entering a new era where we don't have this sort of unipolar world that's focused around the United States and what we want. China is a rising power. China has aligned themselves with Russia. We have other countries that would like nothing more than kind of take us down a peg. And I think that's a risk that we have to continue to focus on as time goes on.
Ayesha, you want to comment on anything that we've talked about on this?
No, I agree with them, of course. And I think the second order of things become more and more interesting. So just as Mayhem said, we focus on everything, right at the moment it's happening, and then, we lose sight of it. But things are happening in the background, right? So the oil situation with Russia, the wheat situation, supplies, everything's still happening in the background, whether we're focusing on it immediately or not. And over time, this does have an impact on the market. So I think, all of you are right. It's not priced in. There's still a lot more to go as long as these conflicts keep happening. And I think more conflicts will happen. I mean, we saw what happened in Sri Lanka, and I think we're likely to see more of this happening across the world, and we will be in trouble.
Yeah. I'm going to take two more questions and then we're going to wrap up there today. I think this is a good question coming from Costum. Do we throw away the VIX? I don't watch it that much anymore, honestly.
I would throw away any crayon lines you've drawn on it. That's for sure.
Are you guys watching the VIX that active these days? I mean, I keep an eye on it. It's not something I watch a ton. I mean, I always know where it is, but I'm not watching it regularly. Are you guys?
I will say I don't draw crayon lines on the VIX. That's I really make a habit of not doing technical analysis, but I do watch it. I watch it for one specific reason. I just like to know whether volatility seems to be expensive or cheap. If it's expensive, I'm more likely to put on spreads. If it's cheap, I'm more likely to just buy contracts. Sometimes when it gets really expensive, I'm tempted to fade the VIX directly as expressed through futures. But I do keep an eye on it. I think it's important, but we just had that lawsuit come out where Morgan Stanley and Barclays are being sued for manipulating the VIX. Of course, we can't forget that VXX was totally imploded. It was horribly mismanaged by Barclays. So in terms of like trading the VIX as a retail person, I'm not allowed to or trying to give any advice, but I wouldn't do it if I was a less experienced trader. I think they're much better, more liquid vehicles to express those kinds of opinions through.
Well, and the other thing I would add is I don't know if you'd ever throw it out, Deli, but I think you might have to adjust to a new normal in the new regime that we're in. Are we going to see VIX 12 again, like the good old days? Probably not. We're probably changing the baseline. And again, I'm not a volatility expert, but I think there's still people that are looking for it to go significantly lower when in reality the entire dynamic and regime of the market, specifically talking about the influence that options have had, especially speculative options, I think you're in sort of the new normal for volatility, that it's going to be hanging out in this 20 range for probably quite some time. That's just my take.
Yeah. I mean, I use it very similar to the way that Mayhem does. It's like I look at it as just kind of a gauge, and maybe it helps me with my execution. Aisha, any comments on that?
No, I think what Horst said is very interesting because somebody actually asked me, why is the VIX low? And it was, I think, at 19 or something. It's not low. I mean, if you look at historical standards, it's not really low. So, yeah, I think Horst is bang on. I mean, it's just that, we've become so used to like a higher level of volatility in this market. I don't think we throw it out, but it is definitely something to keep an eye on.
Yep. Last question for today, because I know you guys got to run. It's a busy Fed day. From Austin Scott, do you think that the Fed has considered the likely bloody Q3 earnings coming up when it comes to demand pulling back or subsiding? Let's go back to you, Mayhem, first for this.
I think that this is what they want. They need to destroy wealth. I mean, look at how many people aren't participating in the labor force. Part of that is people who retired early. And the Fed is probably looking at that and saying, hey, we could alleviate some slack in the labor force by reducing the amount they have in retirement so they have to work more. I know that sounds a little sinister, but you can't rule it out. And the other part of it is that they have to slow the economy. In order to effectuate demand destruction, they need to induce a recession, and not just a shallow walk in the park recession, but probably one that's rather unpleasant and long lasting. It's not going to look anything like the COVID crash. I don't know that it's going to look like the great financial crisis, but I think it's going to look more like your conventional recessions throughout history, where it probably lasts a year or more, where earnings come down 30% or more, and where the market has further room to fall. And that's what they want.
Ayesha?
So I obviously agree with Mayhem. I think there's something that I said like some time back, that the Fed is not going to backstop the stock market. And that's exactly the situation. It doesn't matter if earnings are bloody. I mean, that's exactly what they want, just as Mayhem said. And in fact, that's what they're looking for. I mean, Kashkari came out and said that, they were a little disappointed that the market actually went up after their last FOMC announcement. So seriously, and because this is not what they want to see. What they do want to see is a reduction in demand and that their policies are taking effect. Now, what we saw last earnings season was a little surprising, where companies still came out pretty strong. But if you look at quarterly earnings, like quarter-on-quarter earnings, they're still declining quite a bit. You started with people like Walmart, Target saying that things are going to hell. Now you're seeing Ford coming out and saying things are going to hell, and you're going to see a few more companies saying that. Now, by the time it reaches Microsoft and let's say Google and all these people, it's going to take some time. But because they're more, let's say, a lot of their products are business oriented, right? They sell to business customers a lot as well. So first you see the consumer going weaker, and then you see businesses growing weaker. So yeah, I don't think the Fed cares. I think that's exactly what they want. And the sooner we see earnings come down, the sooner they will stop, or maybe it stops them from tightening too much or over tightening, let's say.
All right, Horse, we'll give you the final word.
Uh-oh.
Whatever you want to say, man. Not whatever.
I don't even remember the question. I saw it on the bottom of the screen, but I do know that it's not a good one for me to be answering. I will trust Ayesha and Mayhem's take on that. But I would say, just sort of anecdotally, that the mantra post-COVID for most market participants was don't fight the Fed, and it is ironic to see how many are doing it now. When they've changed. So I would still say that's probably the best advice here overall, is don't fight them, but they're not on your side right now.
Yeah, well, guys, thank you so much. I know we're cutting it a little bit short today. Everyone's got to go. It's a busy day. And I just appreciate all of you guys helping us navigate through these Fed markets today. All of the Horse, Ayesha's, and Mayhem's Twitters handles are down below in the YouTube chat. Hit the like button if you enjoyed it. Share it. We still got time for people to watch it before the FOMC meeting. Guys, thank you so much again. This was so much fun.
Thanks for having us, Deli.
Thank you so much, Anthony.
And don't forget to check out Trader Aid. They're all working together on it. It's awesome. I'm in there. It's fantastic. You can find more about that also from their Twitter handles, and I'll put that link down below. Trade well, everybody. It's Fed Day. Don't hurt yourself.
That's right. Thanks, Anthony.
See you guys next time.
Take care.
Appreciate it.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.